Hey guys, my name is Max. Thanks for tuning in to the station. It's a beautiful Saturday here in the fall. We got college football coming on. Let's talk about lightning spreads. The lightning spreads have been a big success. Let's talk lightning spreads. We're going to talk QLDY and blocks. All right, so we have Defiance's QLDY, and I want to compare the performance characteristics of QLDY and the lightning spread generally to traditional covered call strategies. I really want you guys to understand that. But we're also going to look at blocks, which is another ETF utilizing the lightning spread strategy to try and kind of better understand it. And also, this is going to become a nightly show. I'm going to start looking at the trades on a nightly basis that QLDY is doing and predicting the dividend and all that kind of stuff. And we're going to look at that stuff also. But first, let's kind of talk generally about the strategy. All right. Now with blocks, they've been doing this for all summer long, but it's not a pure lightning spread play. They have a fund, and about 2/3 of the fund is based in stocks that are running the lightning spread strategy on those stocks. And it's significantly outperformed the NASDAQ since inception, not just by a little bit, by a lot. Right here we have blocks up 46% since inception, while the NASDAQ, which has done great, is up 14%. It's tripling the NASDAQ right now. This thing is insane, and it's doing that while it's paying a yield. Look at this dividends collected per share, $2.15 over a third of a year. You're going to make that $6.50 over a year. Initially, this cost about $20. You can see that's a pretty darn good little dividend or distribution it's paying as well. So that's the lightning spread in action. This blocks has been around all summer, showing off all summer. Of course, it's been a bullish summer. So let's get in the middle of this and figure out what's really going on. All right. There's no such thing as free money. Sounds too good to be true, because this is paying a yield and it doesn't have capped upside. I mean, what's going on here? So let's dive a little bit deeper. The lightning spread itself consists of two things: a long stock or a long synthetic, and then a short put spread. So three legs: you have a stock or a synthetic or a long. So you have a long leg, and then you have a short leg, and the short leg is a spread. It's a long spread. It's a long put and a short put, but it's a short put spread. So it's a three-legged trade. All right. And it could be stock plus a put spread, or it can be a synthetic plus a put spread. In the case of blocks, they're actually using the stock. They own the stock and they're selling put spreads on the stock itself. In the case of QLDY from Defiance, that is a synthetic. We're going to look at the QLDY trades and stuff. I'll explain kind of how it works here in a second. All right. So the key characteristics are, the main key characteristic is upside potential. Unlike covered call strategies where you promise to sell your stock in return for getting some of the yield, you don't promise to do that when you're selling a put spread. You actually promise to buy more stock when you're selling a put spread. So it's more like a double down. And that's part of you'll see that'll kind of make sense with the way the payoff works also, I think, when you think of it like this. It's more like a double down than a hedge. But unlike traditional covered call strategies, the lightning spread does offer theoretically unlimited upside, not even partially unlimited upside like the covered call spread. It offers unlimited upside, theoretically unlimited upside. As far as downside protection goes, this is the critical trade-off of this strategy. Lightning spread actually has negative buffer. You know how regular covered call loses a little bit less on the way down because of the amount of the premium. That's called the buffer. Well, the lightning spread kind of flips that equation on its head. So you actually have negative buffer. So you lose a little bit more on the way down. It's kind of the uncomfortable truth of the lightning spread. I interviewed David Nicholas who's the fund manager for BLOX, who's implementing the lightning spread. And I asked him about that very same thing on my show. And he said the same thing. He said, unfortunately, that's the one problem with the lightning spread is you get a little bit worse performance in a down market. That's the trade-offs. It's not just me saying that. That's David saying that too, and he's the one running these funds. It's just kind of the truth. It's the way it works. It's just the way the math works. Okay, so let's compare this to a traditional covered call strategy. Traditional covered call strategy is long stock plus a short call or short call spread would be the yield max strategy. So like I say, this provides a positive buffer in down markets where the losses are reduced by the premiums collected, but it caps upside potential. The lightning spread, on the other hand, long stock plus a short put spread or a sold put spread, this offers negative buffer in a long market. In other words, the losses would slightly exceed the buy and hold, and by the spread width, actually, by the width of the spread, by the risk that you have in the put spread. But your trade-off is that unlimited upside potential. Both strategies offer distinct advantages on buy and hold, and depending on market conditions and your risk tolerance and whatever tactics you're trying to achieve, maybe if it's a market timing goal you're looking at, one, both, or neither of the strategies might work for you. So let's look at it like this really quick. I really want people to really understand this. And let's just do a really easy example. You could do lightning spreads on anything. Let's say we wanted some stock, and let's say we wanted to go buy open. I have full disclosure. I have 2 calls in open that expire here in 2 weeks, but they're the 10 strike. So I needed to go. But be that as it may, but let's say a guy didn't have an open position, and wanted some stock. Well, you could do, here's the lightning spread right here. You could go buy 100 shares of stock and open at the close on Friday, $811, buy the stock. But then at the same time, you could sell this put spread right here, sell the 8 put, buy the 6.5. And this is something kind of like BLOX would do. I've looked at their trades. This is, within the realm of of a reasonable type of lightning spread that a fund like them might do. But anyway, you could do something like this yourself, and you're selling the 8 put. You're getting $45 for it. You're buying the 6.5 just to cap your downside at $6, but that $39.50 is income. So you actually own the stock. You own open. Cost you $811, but it really didn't cost you $811 because you got a little credit for the put spread. You got a $39 credit. So you actually are in the stock a little bit cheaper than otherwise, and you have unimpeded upside. Okay. So that's one way of doing it. That is the lightning spread. And I'm always talking about, it looks like a lightning bolt. It kind of is shaped like a lightning bolt. The place where it kind of bolts, where it's steeper than the rest of the line, where it has a stronger slope, that's between 6.5 and 8. The thing about the lightning spread is you're double long between the 2 strikes. It's not really leverage, but I call it maybe synthetic leverage or local leverage, because you're levered between 6.5 and 8, or tactical leverage, whatever. They don't call it that, but that's what I'm calling it. That's the way it works. But let's just make an apples to apples comparison. Let's just say the same guy with the same $811. Let's say that this guy has $811. He wants to buy open as well, but he's going to do the yield max strategy. He's going to do the covered call spread. Okay, let's see which one's better. So what he did is, instead of selling the 8 put, he sold the 8 call, and he got $57. The put was only $45, but whatever. So he got $57, but then he bought the 9.5 call to partially uncap his upside. All right, and guess what? That is also a $39 credit. So you could do the same trade either which way. You could do the lightning spread and get $39 credit. You could do the covered call spread and get $39 credit, plus you own the stock. Which one would you rather do? Now, at expiration, we can look at the profit and loss graph. Well, let's just talk about this a little bit. The white line is the lightning spread, and the colored line is the covered call spread, the yield max strategy. So let's say the stock goes up to $9. On the lightning spread, on the yield max strategy, you make $28, but on the lightning spread strategy, you make $131. because lightning spread's uncapped. You just get full upside. Even though you have partially uncapped upside because of this call you bought, it's just partially uncapped and it hasn't kicked in yet. Now, let's say you don't hold till expiration. Let's kind of look at the lightning spread about halfway through. Now, see this white line here? We'll just go out here to Tuesday at the close of business. But even Tuesday at the close of business, you can see the lightning spread. You could close lightning spread trades, and if it's a bullish trade, you're going to be making more than you are with the yield max trade. Doesn't matter how high it goes, because you're going to be making, there's more to be made on the upside. However, in a pullback, if let's say the market goes to 7 in open, okay, well, in the yield max strategy, you just lost $75. Well, in the lightning spread strategy, you lost $171. What happened? One thing, it went between the strikes. Between the strikes, you're double long. So if it goes between the strikes, especially if it finishes underneath them, you have a double loss. But if it finishes on this side of them, you have a double gain. All right. So I think this right here, open with a $39 credit on a lightning spread and open right here on a covered call spread. There's no really right or wrong way to do it. I guess the answer is if you knew the market was going up and you had to do one trade or another, you knew the market was going up, you darn sure do the lightning spread. But by the same token, if you knew the market was going down, you do the covered call spread. The covered call spread does have partially uncapped upside. You aren't capped. You can make up extra upside, and it's quite a bit safer on the downside. However, the lightning spread, you can make quite a bit more on the upside than you can on the covered call spread. So anyway, and remember, this is a covered call spread. We could also look at just a plain old covered call. We could exclude this to make it an apples to apples. That makes $56. But to make it an apples to apples comparison, we could scoot it out $37. Okay. If you just sold the 8.5 call by itself without the spread part of it, you could also bring in $37.5. Then you're totally capped past 8.5. And you can see, I would rather be the white line. I mean, I guess, especially in an up market. But anyway, we have choices. Lightning spread, covered call spread. Also, you have the choice just to buy open and don't do anything with options, just to buy open and hold it long. But I think that's probably the best thing to do. I think the lightning spread may be the second best thing to do because you kind of have your cake and eat it too. You get that $40 credit. You get a little credit, and you could do that once a week. Think about that, $40 a week. I mean, what is that for? Like $2,000, or no, it's $200. I'm sorry, but it's only on an $800 investment. So you could pay yourself about in theory, that's about a 25% yield that lightning spread's kicking off without impeding upside. And I think that's the whole theory of the fund. All right, back here to my deal. We got a little bit off base there, but I wanted to show you guys there just on a dollars to dollars, apples to apples. You can do it either way. Really, there's no right or wrong answer without knowing the future. But I think that's a good comparison of the lightning spread to the covered call and the covered call spread. Okay, so QLDY is Defiance. They're doing it twice a week. They've announced they've paid one distribution, 19 cents, but they've announced another 19 cents. So at that rate, that comes to about a 40% yield. I mean, QLDY has only been around a week. Now let's go to the QLDY graphic. These graphics aren't much, but I've been keeping track of the trades. Right here are the daily trades. That SS means sell short, B means buy. This is the daily lightning spread. They started on September 18th. Anyway, this is the price for the sold one, 91. This is the price for the bought one. This is the profit. The first day we made $5,200. The fund was worth $2.5 million. But even when you factor all that in, that came out to about a projection of about a 45% yield. If they could just make that much money every day, they'd make about a 45% yield. By the second day, they made less. It projected to 31%. Third day was 49%. Then one day they didn't even sell any premium. They didn't have a trade. And then one day, 38%. But anyway, they went for a week. and they made this number right here. They made 37 cents a share. Well, then they announced a 19 cents a share dividend, so that left them 18 cents in reserve. Okay, and then they rolled on, and the trades happened this week, and then this week they also announced another 19 cents a share dividend. So, and that leaves them about a 5 cent reserve. So, but we followed the trades every day. See, they were doing, it says 1, 1, 1, 1. They were doing one lot trades, but then as their fund grew, they started selling 2 options. Right here, they sold 2 options at 96, and they bought 1 put at 30. So that adds up to $6,600. Or it adds up to 66 points, which adds up to $13,000. Okay, well, the fund's now worth $6.3 million, but that comes out to about a 45% yield if they can make that much every month, or about 11 cents a share is how much they made on that one day. Anyway, we're tracking this. It just looks like right now they could easily pay about what they're paying. We'll see, though. That could change. That's why we're tracking this. So like their most recent trade on Friday, they sold 2 options, the 24,610, if you care what it is. They're selling the 610, but then they're buying the 24,450. So that is 160 points apart. So that's 160 points is the risk. So $16,000, but they're bringing in 45 points. So that's the reward. So call that $4,500, so the risk is actually 4,500 less the 16. So it's about 11,000. They're risking about 4,500 to make about, trying to make 4,500 by risking about 11,000. Something like that. That's just with real quick math, but that comes out to about 31% just on that day. But anyway, we'll keep following that. But as far as how it's actually working out, we can just look at the price. Here's the blue line is the price of QLDY with dividends included, because those 2 dividends had to get factored back in here. And the red line is just the price of Q. And QLDY has been leading the whole way, except the day the market pulled back last week. Of course, QLDY was down more for that one day, but has now jumped back ahead. Now the market's on the upside. For instance, if you just bought Qs the day this came out, you would be up 1.3%. But if you bought this, you'd be up 1.6%. Anyway, we'll keep an eye on that. So that's going to be a nightly feature. We'll just follow those trades every night. We can also look at the BLOX trades. We can also look at the BLOX trades every night. And here was the BLOX trades for Friday. So, I mean, it was a big day for BLOX, up 1.4. This also does the lightning spread on 2/3 of the fund. So, and I could show you which 2/3. The first 3 down here, HODL, FBTC or FBTC, and ETHA, no lightning spread, but the lightning spreads are on Hood, Galaxy, Riot, IREN, HUD, Coin, TS. These are all lightning spreads. So they have, and it's just like I showed you on Open. In fact, they might even have Open. Well, they don't have Open, but they could, I guess. But it's just the same. They're doing the same thing that I showed you guys, that they actually own the stock and they're selling a put spread. And look how it's working out on IREN. IREN's up 7.3% today. And I mean, and it's 5% of their portfolio. And that's a big part of the reason they're up 1.4%, because they have that uncapped exposure to IREN, and they have that uncapped exposure to this one, CIFRs, whatever that one is. I always forget. Cypress. Anyway, great job, BLOX. So we'll keep an eye on BLOX, QLDY. I anticipate more lightning spreads coming out. And this show will also probably cover the leveraged funds when they come out, the leverage plus income, because I'm calling the lightning poor man's leverage, or it's local leverage, tactical leverage, situational leverage, because between those 2 points, you're double long. So, so whenever they come out, the leverage plus income, we'll probably also cover those and compare them to the lightning spread, because I think that's really the future of these funds, is the lightning spread funds and the ones that use a little bit of leverage. And I know a lot of you guys have been very happy with the W series funds from Roundhill, and those use a little bit of leverage. Rex uses a little bit of leverage. Now Defiance is coming out with funds that are leveraged, plus at the same time paying an income. All right, guys. Well, I hope you like this. I hope I hope this explanation wasn't too in the weeds, but I think this picture right here, it's like a yin and a yang. I think this picture right here, the white, it's like a yin and a yang. The white is the yin, and anyway, the white line is the lightning spread, but it just yins and yangs, and it does just worse on the way down by the same amount that it does better on the way up. It's very symmetrical, is what I'm saying, and it makes total sense when you think about it. It makes total sense. So, like I say, I hope the explanation wasn't too in the weeds, but I just think if you make an apples to apples comparison, you can $39. That trade makes $39. This trade makes $39. It's the same credit, and both trades are bullish, but it's what happens afterwards that you really have to understand how it works, and then you have to understand how the path dependency works out, and then you aren't surprised. And not to mention, you can plan these strategies in a more tactical type manner. All right, guys, thank you so much, and I hope you have a wonderful Saturday. I'll talk to you soon.